Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, and thank you for tuning in to another episode of No More, Risk Better. I'm your host, Zach Griffiths, head of U.S. investment grade and macro strategy at CreditSights. I'm very excited for this topic today. We're recording on October 30th with guests from around the world. We'll be coming to you from California, North Carolina, and Singapore for a spooky discussion on the eve of Halloween, talking about the 1920s and the Great Depression and how it may compare and contrast to the situation we find ourselves in today. So we are extremely excited to have a special guest, Barry Eichengreen, on the podcast today. Barry needs no introduction, but if you are hearing his name for the first time, he is the George Pardee and Helen N Chair and Distinguished Professor of Economics and Political Science at the University of California at Berkeley. Barry is one of the world's most recognized economists and economic historians, having made huge contributions to so many areas of research, including the 1920s, the Great Depression, global currency crises, the US dollar, the global financial crisis, and fiscal and debt dynamics, just to name a few. I personally just finished reading Exorbitant Privilege, which I really enjoyed. Barry also has a forthcoming book in March 2026, Money Beyond Borders, Global Currencies from Crises to Crypto. So Barry, thank you so much for coming on the podcast.
Good to be here. I have to tell you, Zach, that my wife was quite alarmed when I told her what the topic of this podcast was. She said, how timely, how alarming.
Well, I think it's extremely timely. Hopefully it doesn't pan out to be too alarming, but we're extremely excited to be discussing this with you today. And of course, I also have with me Cedric Chehab. He is the chief economist at BMI, probably the only other person in the world that could be more excited for this podcast discussion than I am. Cedric, thanks for coming on.
Thanks for having me.
Okay, Barry, so let's get right into it. We keep on hearing that this is starting to look like the Roaring 20s. Can you kind of compare and contrast from your perspective what you're seeing in the financial markets and the economy today that looks a little bit like then, and kind of take us through your thinking about that comparison?
Well, the boom of the 1920s was fed by a combination of factors, as stock market booms always are, ample credit together with enthusiasm about new technology. So there is an obvious parallel with what's going on at the moment. Back then, the new technology was radio, and radio was used to promote the merits of radio. RCA was the stock that led the boom up. It crashed in 1929, and it took the better part of 15 years for it to rescale the heights that it had reached at the end of the 1920s. So the parallel with AI and the role of the internet in promoting enthusiasm for AI, I think, is pretty direct. We have had a long period of loose accommodating credit conditions. That is now ending. And the trigger, arguably, for the crash in 1929, we never know exactly why markets crash, but that crash was preceded by significant tightening by the Fed, and we have gone through a tightening cycle recently. So there's lots to think about.
Yeah, those are a lot of great points. I feel like one that has come up certainly in some of the discussions that Cedric and I have had is the productivity growth Is there anything you're seeing there in terms of anything? And I don't know how discernible this is in the current data, but some of the productivity growth that we saw then and maybe the early signs of that now, do you think that's kind of playing into the comparison to some extent?
Well, as you say, I think it's too early to know what the economy-wide impact of AI and new technologies more broadly will be in the course of coming years. What's interesting about the 1920s and 1930s is that the 1920s was not an exceptional decade for productivity growth. So the um, boom on Wall Street was not driven by uh, current productivity growth. Alexander Field at Santa Clara University has a great book on the 1920s and 1930s, and he shows that productivity growth was actually faster after the crash in the 1930s, when businesses reorganized to uh, uh, adjust to very different economic conditions, when trucking rolled out for the first time, things like that. So that's not one of the new technologies we immediately think about when we think about the 1920s and 1930s, but trucking in the 30s and then the interstate highway system in the 1940s and 1950s was um, critically important. So maybe that's the an analogy with data centers. It will take time, but they will, investment now. If AI has a payoff, it will come later after their expansion.
I think that's really interesting to point out that we could see a crash between now and the time that the productivity growth becomes really evident from AI, something that might not be front and center in terms of market performance that we've seen at least over the past couple of years.
It's kind of what we saw with the technology boom in the 90s, right? So they laid lots of fiber. The internet adoption was a bit slow, but the productivity gains from the internet were felt many years after the crash, I would assume, and we're still benefiting from them now.
And one can tell the same story about the railways, for example, in the 19th century. Lots of investment, lots of problems and losses for investors in the short run, but big benefits for productivity down the road or down the railroad.
One of the other big topics that's come up recently is around the risks of fiscal dominance and maybe some pushing for something that looks like that here in the US. From your perspective, Barry, why is that so risky? And is there anything we can learn from Germany in the early 1920s from that perspective?
Well, Germany in the 1920s was certainly a case of, up through 1923, a case of fiscal dominance, when there were big demands on the government budget that could not be met ultimately. Central bank printed money to bridge that gap in the short run, with very grave negative consequences subsequently, both in terms of saddling the German economy with high interest rates for the remainder of the 1920s, something that made it totally dependent for investment on capital inflows, which dried up abruptly at the end of 1928. And I would not write off the impact of the hyperinflation when I thought about the rise of political extremism in Germany in the 1930s. Some financing budget deficits by printing money is very dangerous, and I do worry about that in the United States in a period when we already find it difficult to get our arms around the deficit problem, when the government is running a budget deficit north of 6% of GDP, which on current law will lead to on current law, 150% of GDP budget deficit by 2055. That seems a long way off, but um, I think we need to start worrying now, and that's why I worry about threats to the Fed's independence.
Definitely, certainly alarming to be on that path, even if it is a little bit of a ways off. Cedric, I wanted to turn it to you for any additional thoughts on the topics we've covered here, whether it be fiscal dominance specifically or some of the similarities and differences you're seeing between now and about a century ago.
Sure. So just in terms of some similarities, I think the polarized politics is something that jumps out at me. Barry, I think in your book you talk a lot about kind of France in 1924, and neither the left nor the right wants to bear the burden of adjustment, and so it gets kicked down the road, and then ultimately, the central bank in that case also intervened. You didn't have a great result, if my memory serves me right. And I think, of course, we're not seeing the same thing now, but when I look around Europe and I just see that there's, very little political will to make those adjustments. And Barry, I think you talked about, Jamaica being one of the outperformers in that regard a few years ago, where they got their act together. But it's very few countries that really get their act together and are able to figure out this burden of adjustment. So that, for me, from a politics perspective, is particularly interesting, because I ultimately think that these decisions come down to politics. I guess in terms of, sorry, go ahead, Barry.
I very much agree with that. I cannot resist citing the paper I wrote with a co-author for the Fed's Jackson Hole conference in the summer of 2023, and we looked at we looked at all the episodes we could find going back to about 1960, where governments with heavy debts and big budget deficits were able to consolidate successfully, and we found only two robust correlates of that success. One was a healthy economy growing the denominator of the debt to GDP ratio as the painless way of bringing that relationship down. And the other one was low levels of political polarization, where the different political factions could agree on a strategy and they were able to stay the course. So that leaves me pessimistic about the prospects in the U.S., at least at the moment. You, Cedric, are probably pessimistic about the prospects in France.
Barry, I got to ask, so what were the two instances?
Well, we found a number of historical instances, probably 40 going back to 1960 in all, but there were only these two robust correlates or determinants.
Got it. It seems like growing the denominator in the U.S. has to be where the optimism could be, especially from AI and productivity growth and everything we're seeing there. I think for us, we see it a little bit more as a risk in terms of some of the overspending and maybe not getting the return on investment on some of the CapEx that's being done now. But that's a completely separate issue. Cedric, going back to you, I know we've kind of commented on some of the similarities. How about some of the major differences that you're focused on in terms of what we're seeing now versus in the 1920s?
Yeah, I think that's a good question, because I see a lot of people just saying, oh, it's like the 1920s. And it's like, well, there are a lot of differences, right? So one of them is kind of you didn't have hyperinflation right now. So that's a big difference. And that means that you don't decimate parts of your economy, your middle class, etc. Currently, we have much stronger banking sectors than we did. That's because of the policies implemented after the GFC. We have maybe better regulation in that regard. We haven't seen a huge pickup in corporate debt. I think there was a big pickup in corporate household debt in the 1920s, whereas here we're seeing more of an increase in government debt. I think a big factor is after the 1925 or so, a lot of the countries were back on the gold standard, which meant they had fixed exchange rates, so to speak, and that limits policy flexibility, where nowadays most countries, have flexible exchange rates and have much more kind of monetary and exchange rate flexibility there to respond to shocks.
Barry, I'd love to hear your perspective on the key differences between now and a century ago, in addition to what Cedric mentioned, or maybe which of those you think is kind of most important and why we can't draw such a direct comparison. There's plenty of reasons, but what kind of sticks out to you on some of the matters that we're considering here?
I think Cedric summarized it very well. I have worked for many years on the role of the gold standard in the Great Depression, so I, of course, would underscore that one as a constraint on the ability of central banks to respond when things began going sideways. Another important difference is that central banks have had much additional experience, starting with the Great Depression, but in subsequent crises as well, which inform their view of how they should respond to events. So even central banks with policy flexibility like the Fed didn't respond in an adequate way in the 1930s because they subscribed to the real bills doctrine that they should only provide credit for actual commercial transactions, which were declining in number, declining in volume in the Depression, so they provided less credit. Or they believed in liquidationist theories where they needed to teach the speculators a lesson by not responding to events. So I think both monetary and fiscal authorities, there's plenty to criticize about how they responded to COVID, for example, but inaction is not an accurate characterization of what they did. The other thing I would say, and I pose it to the two of you as a question, is the banking system might be better regulated, but what about the non-bank financial system? What's going on with private credit and with the repackaging of these investments that are being sold on to other holders? It's hard for a non-specialist like me to completely understand. But, part of what happened in 2008 was that the Fed had learned to keep its eye on the banking system after 1929, but things went wrong in the non-bank financial system. Could we be seeing another variant of the same thing now?
That's a great point. And we're coming out with a podcast today. I just did with our regional banks analysts and our BDC analysts. So using BDCs as a window into the world of private credit to kind of assess credit quality in terms of what we're seeing in those portfolios. And for now, I'd say our tone, at least from CreditSights perspective, is reassuring in that we're not seeing a complete deterioration in the credit quality of those loans. But I think that's a really awesome comparison to make or comparison to draw to that time, Barry. So for now, we're not seeing huge issues, but I think it's a great point that the Fed has control over the regulated banking system. And to the extent all of that regulation has shifted some of the provision of credit outside that banking system, that certainly could lead to problems in the future. The other thing I really wanted to get your view on and kind of thinking about the current administration and less global coordination, a focus on more bilateral transactional relationships. Is that something similar to 100 years ago? And if so, are there lessons that you think we could take from that experience and apply to today in terms of maybe what policies are being put in place that could work and ones that might be destined for a bumpier path?
Well, one of the problems in the 1920s was a decline in central bank cooperation because the French and French central bank on one side and the German and Austrian central banks on the other were at loggerheads over issues like reparations and rearmament by Germany and a proposal for a German-Austrian customs union in violation of the agreements reached in 1919 at Versailles. That made cooperation, which had been developed already in the late 19th century and early 20th, made central bank cooperation more difficult than it had been previously. The Great Depression was a global phenomenon. It wasn't really possible for a single central bank and government to respond to it adequately. So the failure of cooperation was a big part of the problem, in my view, in the 1930s. What developments in the last year have not been favorable from the point of view of central bank cooperation. There are exceptions to that. So I actually spoke day before yesterday to CSEN, the annual meeting of Southeast Asian SEACEN central banks. So there is cooperation. There are efforts to foster cooperation within Southeast Asia, for example, but it's hard to imagine the Fed and the People's Bank of China cooperating on much at the moment. And the European Central Bank officials there have voiced their worries that the swap lines from the Fed they have relied on in the past may not be made available to them by a more politicized Federal Reserve in the future. So this is an opportunity for the Europeans to encourage more international use of the euro, but it's also a danger in the event of unforeseen events.
If I could jump in there, I've also been hearing that for some of our customers who they've asked me whether the Fed swap lines would be politicized. And I think that's a great link you made there, Barry. I hadn't thought about it, taking it back to the 1920s, but I know some of the banks that we talk to, they do worry about that. And not only in Europe, across Asia.
Yeah, it's great to have that fresh perspective, Barry. So, Cedric, I wanted to turn to the equity markets and just frame up exactly what was going on in the 1920s. I think people are familiar with the crash, maybe not completely familiar with the magnitude, but the stock market had fallen about 40% in the first year and a half of the decade, went on to rally by almost 500% by late 1929, with about a doubling since early 1928. What do you think brought the end of the Roaring Twenties, and what are the lessons to be learned for policymakers nowadays, kind of using that equity market framing?
Well, I think Barry mentioned it's really hard to know exactly, but I think when you have a long expansion where you have a lot of debt and the central bank tightens policy at a time when you had kind of non-bank lending as well and quite a bit of risk taking, then that typically results in a pretty bad outcome. I think over 1928 and 1929, the Fed hiked about 250 basis points to 6% or so. And this had a big impact. There had been a big buildup in corporate debt, in mortgage debt, loans to kind of the non-financial private sector was quite large. Also, there was a lot of speculation. I saw a stat that investors were allowed to get a 10-to-1 leverage on some of their stock investments, which you hear about these kind of leveraged ETFs nowadays of being 3x or 5x or 10x is quite the risk takers. But Barry also mentioned something earlier, which was a little bit felt like there was maybe a market frenzy that the Fed tried to address, and it seems to me maybe almost a moral judgment, right? That they were worried about maybe American capitalism at the time. And I think it was reported that Andrew Mellon, who was Treasury Secretary in 1929, he said, kind of the famous quote, liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate, and it'll purge the rottenness out of the system. So I think there was a big focus maybe on the speculative side of it, because if you look at some of the inflation data, right, it wasn't terrible. Inflation was maybe a little hot, but not too hot. And so it just seems as if maybe the Fed was focused on really curbing markets. And I think the problem there is you have unintended consequences as well when you tighten. We know that after long cycles. So one of them was kind of a sudden stop of capital going to Europe. That exposed a lot of weakness there. Apparently, it also ironically led to more broker lending in the U.S. as they were able to charge more, and so more brokers were lending. And of course, through kind of higher interest rates on debt servicing, that impacted kind of the economy, and then of course lower equity prices, then that hurts from a wealth effect. So I think we can blame the Fed. I don't know.
Can we blame the Fed, Barry, do you think?
So when I lecture on this topic, I tell my students if I could explain and predict stock market booms and crashes, I wouldn't be in front of this class. I'd be out there investing, and that probably applies to this podcast as well. Cedric and I are very much on the same page in terms of trying to understand what happened. So I don't know that I have a lot to add, except to number one, reemphasize that enthusiasm over new technology as a factor in the run-up, and to do a shout out to Eugene White, at Rutgers University, who's done some nice analyses of the boom and crash, and he shows that stock prices and dividends move together as they should. Equity prices are supposed to be the present value of expected future dividends. They do move together for much of the 1920s, and then they kind of decouple in 1928 and the first half of 1929. Stock prices move up in a way that's not accompanied by, not justified by, if you will, dividends. So if there was a bubble, it becomes evident in the last 12 to 18 months.
Yeah, I think another way to think about that is maybe aggregate equity market multiples, and when that really starts to hit a certain peak, then I'd say the risk that we are in that last 12 to 18 months becomes much larger. And so up to this point, obviously we've talked about the roaring 20s, some of the things going on there that were driving markets, and we've touched around the fringes of the great crash and eventually leading to the Great Depression. When Cedric and I have talked about this, he kind of mentions there was a triple whammy of a global banking, a balance of payments, and a sovereign crisis. And just to put some of this into perspective for our listeners, over the worst of the Depression, we saw money supply fall by 30%, real GDP fell by a similar 30%. Unemployment, I believe, hit 25%, and some 9,000 banks went bust. Barry, I know we've hit on policy a little bit. We just talked about the Fed and some of their actions and how that could have contributed to the stock market crash, which then led into the Great Depression, which, as you mentioned, was a global phenomenon. But what were some of the policy mistakes that you think compounded the crisis or allowed it to become more global or go on longer than maybe it would have if other policy decisions had been made?
Zach, I should clarify that the numbers you cited are all accurate to my knowledge, but they're for the U.S., not for the world as a whole. So
Yes, thank you.
one of the ways we can try to understand what the important steps and missteps were is by comparing the Depression across countries. So an example would be that the slump was less severe in the UK than it was in the US. Part of the explanation for that was that the UK abandoned the gold standard in 1931, the US only in 1933, but that earlier abandonment and elimination of the need to strongly defend the exchange rate meant that the Bank of England was able to cut interest rates in 1931, and that helped. So to come to your question, I think in the U.S., most serious problems were three banking crises in 1930, 1931, and 1933, and the very limited steps that the Fed took, in particular, to contain those banking crises. And Bernanke famously argued in his academic incarnation that this led to uh, um, a credit crunch through the bank lending channel. Banks in distress stopped lending. It contributed directly to the contraction of the money supply you described, and a fall in the price level of about a third between the peak in 1929 and the trough in 1933. Other countries that were more open than the U.S., I think, were mainly affected by different kinds of shocks. Some of them had banking crises, mostly not as severe as in the U.S., but they were on the receiving end of that sudden stop. They experienced currency crises, first having to defend their gold standard parities and then experiencing all kinds of chaos when they abandoned them. So in the U.S., I would prioritize the banking crises as the main factor that aggravated the Depression. For other smaller, more open economies, probably the balance of payments crisis. I should flag something that we haven't talked about, which is tariffs and retaliation. I think modern scholarship says they were not helpful, but they were not the main factor compared to banking crises and currency crises.
Yeah, it's funny because when the tariffs came on, and people started making comparisons to Smoot-Hawley in 1930, I said the tariffs were bad, but actually when you pop the hood and look underneath, it was actually a banking crisis. So it's not the same thing. And I remember telling some of my colleagues, and that's why I also got really interested in the period as well.
And Cedric, I know we've talked about this a little bit, and Barry led in, with this comparison across countries, just thinking about how various countries treated their commitment to the gold standard during that period. The UK coming off the gold standard probably helped limit the extent of the damage. Can you take us through any more important points about the structure of the gold standard and how it exacerbated the problems of the Great Depression?
Yeah, so first of all, I'll just say fixed exchange rates are not great when you're facing multiple pressure points on your economy, because you need that policy flexibility. And there's good reason why they wanted to hold on to the gold standard, because it was essentially a way to, I guess, reduce the fear that they would return to hyperinflation, or they were actually quite concerned about inflation. So gold standard was basically a way to prevent those fears from reemerging. But there's some other interesting things, like the U.S. and France were large surplus countries, and they were hoarding a lot of gold. And they were hoarding a lot of gold at a time when liquidity was, and they're forcing a contraction in liquidity, which meant those deficit countries, which were already raising interest rates and cutting spending in order to rebalance their balance of payments, were put under even more pressure, because all the gold it wasn't coming back as they should do as they reflate their economies. Then you had kind of this pyramid or kind of fractional system, whereby you held 40% gold, and then your money supply is kind of built off of that. But that means that in a fractional system like that, you have about a ratio of 2.5 of money supply to gold. And so if gold is falling, then your money supply is kind of contracting at a faster rate. And so that's the credit contraction part of the conversation there, and it makes it very difficult. And one of the other things was, because the gold standard was a way to force discipline after the hyperinflation of the 20s, a lot of central banks actually didn't have as much policy flexibility as they needed. So they weren't allowed to buy government bonds in large amounts. France is a good example. And that meant they just held on to more gold and hoarded more, and weren't able to kind of reflate, so to speak. So I think those are kind of some of the structural things that come to mind.
And in terms of how, I know we've already touched on this a little bit from a global perspective, but how did the crisis work its way through various economies across the globe? Can you touch on that in a little bit more detail?
Sure. So the main channel is kind of fixed exchange rates, gold standard, but it's also like what we saw, for example, during the GFC, capital flows and the banks, right? So each country was scrambling for gold, trying to shore up their balance of payments. So U.S. was raising interest rates. A sudden stop. Well, this was before, in kind of 1928, 29. U.S. was raising interest rates. That caused a sudden stop of capital flows to Europe. And in the second half of the 20s, 60% of all lending came from the US, and a lot of it went to Germany. So that was a big shock. You also had falling commodity prices, given the kind of growth shock and the terms of trade for a lot of commodity exporters in Latin America. So Latin American economies started to default as well. And then that started to cascade. The European banks were in bad shape, particularly Germany and Austria, relying heavily on short-term deposits and kind of foreign depositors, which is a recipe for disaster, as we know. They had to suspend convertibility in Austria and Germany, so they froze their deposits essentially. And then it started to have cascading effects. So, for example, the UK had I think it was a trade deficit, but it had an income surplus. But because the money wasn't flowing anymore from Latin America, because they couldn't pay, and lots of UK deposits were frozen in Germany and Austria, that put a lot of pressure on the UK government. So they were forced to make a very difficult decision. I think, they didn't really have the appetite to cut fiscal spending anymore. And I think the central bank at the time the Bank of England basically said, if we raise interest rates, it's not going to really solve things. So I think they decided to go for the option to, leave the gold standard, devalue, as Barry mentioned. But the problem is that as they devalued, that boomeranged back to the US, because then there were concerns that, well, if Britain devalued, then will the US go off the gold standard? And so there was a speculative attack, so to speak, on the US. And that forced the US Fed to raise interest rates. Now, can you imagine raising interest rates when your economy is heading south and your banks are going bust? Like, I can't imagine a worse result. And I think that's kind of how it traveled around the world and kind of boomeranged back to the US.
So this is definitely not one of those podcasts where the two guests argue furiously with one another. I think Cedric's last point is really on the mark, that the dilemma was, does the central bank raise interest rates to defend its exchange rate and stay on the gold standard, or does it cut interest rates to support its economy and its banking system? And depending on their earlier histories, central banks responded in different ways. The problem in the 1920s and 1930s was that the commitment of central banks, governments, and societies to the gold standard was not as credible as it had been earlier. The authorities came under political pressure to pursue other goals. I'm kind of reminded of calls at the moment for the Fed to cut interest rates by 250 or 300 basis points. So they couldn't really suspend the gold standard temporarily and vowed to go back on it later, as the Bank of England had done a couple of times in the 19th century. Credibility was less. I cannot help but mention that by the time this podcast is posted around November 1st, you'll have seen my piece in the Financial Times on Argentina. I think the Argentine government suddenly, for the moment, has credibility and political support, having come out of Sunday's election victorious. What better time to introduce a more flexible exchange rate than when you can argue we were not forced into it by political weakness. And the other thing I think I would point to is that we have seen scramble into gold by emerging market central banks recently, just like we saw a scramble into gold in the early 1930s, when confidence in the stability of the dollar began to crumble. Central banks liquidated their dollar reserves and moved into gold. Cedric described how there was only so much gold to go around, so the consequences were deflationary. If there hasn't been a severe deterioration in the dollar's safe haven status yet, but were such a thing to occur, it could prompt a scramble into gold with deflationary consequences.
There's a bunch in there I want to get into more. Cedric, yeah, you go first, though.
So I just want to mention something. So one of the things which sometimes we don't realize as economists is deflation is a pernicious evil, in the sense that your interest rates can go to zero, or one. If you have deflation, like -3, -4, -5, in real terms, the cost of financing is very high. And I think a lot about kind of this deflationary aspect of tightening monetary conditions, and especially in an environment if you have a move away from the dollar. So that's something I don't worry about it too much, but I think over the long term, these are important things to think about.
I think it's a great point on how terrible deflation could be, when it seems like maybe some of the U.S. public would like prices to come down, and obviously having prices in some areas come down is not going to cause broad-based deflation, but broad-based actual price level declines would be a really challenging thing for policymakers to try to address. But Barry, you kind of mentioned what we're seeing in terms of gold prices and maybe a flight to gold by EM central banks. And there's been a lot of talk about the dollar and it coming off some of its recent peaks. So obviously you've written a ton about the dollar. I loved reading through Exorbitant Privilege. What are your thoughts now, maybe in terms of how much gold is playing a larger role in the global financial system and contributing to the run-up in price versus what I'd say is a relatively modest decline in the dollar that we've seen this year in aggregate? Do you think these are early signs of a broader shift away from the dollar by the global economy and financial markets, or is that a little too early to say from your perspective?
Can I answer both? I think um, worries about the dominance of the dollar in central bank reserve portfolios and the dominance of the dollar in global foreign exchange markets and cross-border payments. Those worries have been around for a long time. The term exorbitant privilege dates back to 1965. When it was first uttered, I think, by the then French finance minister. So the worries and the complaints are of long standing, but they have not been accompanied by dramatic erosion of the dollar's global dominance. There has been, at best, a very modest decline in that dominance in foreign exchange reserve portfolios and the number of central banks around the world that peg their currencies to the dollar, but not noticeably on other dimensions. I do think that worries are more immediate now than they have been in the past, and we can't rule out that this glacial decline in the global dominance of the dollar will now accelerate. That's what glaciers do, right? They melt slowly until they collapse into the water. And there's plenty for central banks, for official and private foreign investors with dollar-heavy portfolios to worry about. I don't think I have to run the list.
I have 1 or 2 points on that because this is something I've been looking at a lot, and I agree with you, Barry. It's kind of a glacial pace. So I have 2 questions, and I don't know if they're not questions for anybody in particular, but it's kind of 2 questions that are bugging me. So one of them is, if we were to move into gold, then it's not so much only about the dollar; it's about treasuries used as collateral for a lot of transactions and lending. Could gold serve that same purpose if, for example, gold would then be held domestically because you don't want to hold your gold in New York or London because you're worried about sanctions? And if gold is held domestically, is there a risk that it doesn't function as that service, as that kind of collateral? And then the second question is, the Chinese are the largest trade partner for most economies now. But the big difference between the US and China is that the US ran a trade deficit with about over 50% of countries, so on aggregate, a current account deficit, whereas China runs a trade surplus with about 75% of its trade partners. It only runs a deficit with those commodity exporters, really. And so the question of kind of yuan liquidity, for example. So those are 2 questions I'm trying to grapple with. I don't know if either of you have any thoughts. Just wanted to put them out there.
Sure. So on the second one, China may run a trade surplus, but it's also a big foreign lender. So other countries can get their hands on Chinese renminbi in principle through cross-border loans. Chinese banks are lending now heavily in renminbi, where in the old days they would denominate those loans in dollars. The PBOC provides swap lines to pretty much everybody who wants them. So there are other channels, but Chinese capital controls remain. So there are limits on internationalization of the renminbi. I don't think China's trade surplus is the principal one. Chinese regulation and the fact that the renminbi is starting out so far behind the dollar in terms of being a global currency, those are the binding constraints. On gold, I think you're right that gold vaulted at the London Metal Exchange, the Bank of England, or the New York Fed can be used as collateral in financial transactions. It can be lent. Gold vaulted at home cannot. So it is intriguing that the Chinese authorities are moving now as fast as they can to turn Shanghai into a global gold trading center, such that gold vaulted in Shanghai could be used in financial transactions in the same way as gold vaulted in London and New York. But gold vaulted in Moscow and St. Petersburg is safe from garnishment, but sterile from the point of view of global liquidity.
Yeah, that's a great point. I feel like the one thing I would mention, at least on terms of what we're seeing in treasuries and the dollar, and if the gold prominence is really a sign of that, is that you're not seeing treasuries sell off kind of in the way that I think, or even the dollar, that would be symptomatic of kind of that broader move to gold, Cedric, and in terms of whether or not the gold system as it's set up could support it. I think Barry's answers are on point, and I don't have anything to add there. So I think we've covered a lot here, but I wanted to wrap up and maybe get both of your perspectives on the policy lessons that we learned from the Great Depression, and if any of those could help policymakers today. Barry, what are your thoughts on that?
I must start with the importance of having a central bank staffed by well-informed policymakers whose information set includes historical experience of what to do and what not to do. The Fed's independence was reinforced by the 1935 Banking Act, which I think took the Treasury Secretary off the board and made it more independent. So having a central bank that has the insulation necessary to do the right thing and the smarts necessary to do the right thing, that's one lesson. And the other one is the importance of being able to mount countercyclical fiscal policy when needed, and the fact that we haven't exactly kept our fiscal powder dry, that scope in the U.S. and in many countries for using fiscal policy as aggressively as we did in 2020, 2021 is much less. That's worrisome. And finally, your and Cedric's points about being sure that the banking system and the non-bank financial system are strong going into a period of turbulence. That's important as well.
Cedric?
I'd say a stitch in time saves nine. I don't know if you're familiar with that expression, Zach. Move quickly on liquidity if necessary, and work with kind of both monetary and fiscal policy together. I think banking crises are terrible, right? Avoid balance sheet deflation, right? So that's really bad for households, banks, lenders, and I think that's usually hurts much more than you think. And just thinking back to the 1920s, 1930s, figure out which constraints you're operating under and decide which ones you're willing to break, and pick your poison essentially that way, because it's ultimately a political and distributional problem. And if you're operating under the wrong assumptions, then you're probably making policy decisions, the wrong policy decisions for a while longer than you would otherwise.
All great points. I can't help but think of, and this is probably getting a little too in the weeds for at least some of our listeners, but Barry's point on not keeping our fiscal powder dry, thinking about how Treasury now is even shifting to finance more of the deficit with T-bills and kind of leaving less of a buffer in terms of how we have financed the initial fiscal spending with respect to the financial crisis back in 08 and 09 and what we did in during COVID. I believe Treasury issued 2.3 trillion of T-bills in the second quarter of 2020 alone. You can't do that with nominal coupon treasuries. And so I think those are certainly some things to keep in mind as we look forward and consider the risks that we could be facing with the policy mix that we're looking at now, and some of, I guess, the concerns that we have with Fed independence and the interaction between Treasury and the Fed. So we covered a lot here today. It feels wrong to let Barry go, but Cedric, unless you have anything else pressing that you want to ask Barry, I think this is a great point to wrap up the podcast.
No, I'm okay. Thank you so much.
All right. Well, with that, Barry, thank you so much for coming on No More Risk Better. This was a great conversation, and we really appreciate you taking the time to discuss some of these very important topics with us.
Thank you both.
All right. And thank you, Cedric, as always, for coming back on the podcast. I'm sure we will be discussing other pertinent issues again soon. And with that, we will wrap up. Thank you all for tuning in. We will catch you next time on No More Risk Better.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.